Hey, everybody. John and I wanted to jump on a call to discuss a few new things that are going on in the market and give you a sense of what we're doing to move forward with these new dynamics. We've gotten a number of questions from clients, prospective clients, people in the industry, and I think it's important to understand this new dynamic because I don't know when it's going away, and neither does John. And so we thought it was important to kind of put out a video more than writing about it because I think it's going to be better explained by John and I in person. But again, for those of you that don't know who I am, I'm Jason Hilliard. I'm one of the co-managing directors of Forecast Capital Management. John Pasili is also the co-managing director of Forecast Capital Management. And we're going forward. If we see new dynamics kind of come to the forefront, we're going to do more videos like this as we try to do with other things. But what I'm going to first do is I'm going to hand it over to John. John's going to explain the first dynamic that has changed in the market and explain to you how it works and also how we're kind of making sure that we're up to date and can move forward with this new deal going on. So John, I'll leave it up to you.
Okay, thanks, Jason. So I described a little bit at our quarterly call this market dynamic called 0 days to expiration options. And when I talked about it, during our podcast 3-4 weeks ago, it was still in its infancy. Well, now it's pretty much exploded and is impacting markets every day in a very big way, and that we need to incorporate into our process. So what this is if you recall from that podcast, I said there were 3 players: Susquehanna, Goldman Sachs, and Citadel. And they basically control the options market. Now, the options, basically, for those who don't know, the options market is a market where for a relatively small amount of money, you can control a lot of stock and you participate in that stock's movement depending on the option you buy, whether it's a call, which is you're bullish on the stock, or a put and you're bearish on the stock. So the way it works is, let's say you're really bullish on Apple. It's trading at $200 a share. You like it at 205, so you go buy an option that expires in, let's say, a month at the 205 price, and you hope that within that month, Apple goes at or above that number of 205, and you make a nice profit. And it's also a levered bet. So what these 3 major participants are doing these days is they're basically going in and massively moving the markets in the direction that they want to move it. And the way they're doing it is they'll say, okay, we're going to go buy, the 3 of us, totally illegal, frankly, by the way, but we're going to go in, we're going to buy 400,000 contracts for the S&P 500, bullish call contracts that expire within 6 hours and have a strike price, let's say, of 1% or 0.5% higher than what the market is right now, or 1.5% higher. What that does is then the other market players see that trade, they come in, especially the options dealers are going to say, holy crap, somebody's buying all these calls. It's a very bullish sign. I got to reduce my shorts. I got to sell volatility in order to hedge myself. Then the algorithms come in and say, oh, wait a minute. The volatility indicators are crashing. This is a really, really bullish setup. We got to go all in. And the same thing happens with the CTEs and all that, all these different trading platforms. So next thing you know, this market goes straight up for absolutely no fundamental reason, nothing, no data, no nothing. And what's even worse is just in the last week and a half, Powell, the Federal Reserve Chair, has had 2 different talks where he's come out and said, hey, I'm basically hawkish. We're going to keep raising rates. We're going to keep shrinking our balance sheets. The stock market started to go straight down when he said that, and then within seconds just turns and goes straight up. Well, that's those 3 players that are trying to manipulate the market. As everybody's selling and going short, they're saying, all right, let us screw them all over. Watch this. And bang, goes straight up. Fundamentals are getting worse. Powell was very bearish or hawkish, right, which is not good for markets, yet the stock market goes up 3%. What the hell happened? So that's the new dynamic that really just started about 4 or 5 weeks ago and has really intensified in the last 2 weeks, that we're having to change our process. So we're now in a position where, even though the data tells us this is a negative setup for today, stay short or go shorter, we're now forced to watch the options market and say, okay, what games are they playing over there? Because we may be totally right fundamentally and get it totally wrong. because they decided that they're going to pump the market up 2%. So in a layman's terms, we're basically having to now incorporate in-your-face market manipulation with everything we do. We're not looking for an excuse. We're just telling you that's how the market is currently running. And thank God we're starting to figure this out and have figured it out. Because guess what? Like today, they tried that game when it didn't work. Then they started buying a bunch of puts. And guess what? The market went down a couple hundred points, right? So this will go both ways. And potentially this sets up the volatility to such an extent that you do open up to some kind of a flash crash. Does that make sense, Jason?
I think so. I think it's important that everybody needs to understand, like, this isn't something that you can necessarily plan for. When John and I go into, let's say we go in tomorrow, we have two ways we can work the market that day. And it's dependent now on where all the volume or the flow is going. Is the flow going to go to the call side? Is it going to go to the put side? When is it going to happen? As an example today, John, I don't think they started buying puts until later in the day afternoon. Mm-hmm. Is that right? When did they start buying those puts at the 410 level?
Yeah, it was after.
So John, so John and I basically have to, you know, if we have shorts on, we got to keep those shorts because we don't know if they're going to go on the put side or the call side, where the volume's going to go. And then we also have some long positions. So in a sense, we're kind of net neutral at this point, or very slightly long or very slightly short, because the fact of the matter is wherever that volume flow goes is where the market's going to get pushed. And we're not talking about hundreds of millions of dollars here, John. We're talking about what, 8, 10, 20 billion dollars, right? I mean, that are going on
10, 20 billion. Yeah, they're $10 to $20 billion bets that expired today. That's insane. I mean, that has never even come close to happening. I mean, at one point last Thursday, when they did this in a really big way, hedge funds got so panicked that they covered their shorts to the tune that you almost have never seen in the last decade. The volume of short covering by hedge funds went parabolic. So at this point, you're sitting in a market that's very swayed towards the bullish side, even though the fundamentals and the recession keep getting worse and worse and worse in an accelerating manner. Guys, this is getting scarier faster. The recession is here, and the data is collapsing at warp speed. Yet all these games are being played. You know, the S&P is up 7-8% for the year. Everybody thinks it's the beginning of a new bull market. And, like, we've seen this before. Go back to 2000 and go see what happened. You had rallies of 20 to 40%, like I mentioned in the podcast a few weeks ago. And what happened after that? They got destroyed because the fundamentals took over. The profit recession took over. The recession took over. So for those of you panicked that, hey, we're missing this move could be over in like 2 hours. I mean, with this kind of games being played, I've seen this happen. You get a flash crash, you're down 10, 15% in a freaking hour, right? So we're sitting here saying, we got to protect your downside. We need to kind of play this crazy game, even though the fundamentals make no sense and the data is telling us don't. But we still got to kind of play that game because obviously we don't want to fall further behind the markets. But at the same time, we got to get ready for a potential serious decline. So it's you know, obviously that's why you pay us, but we want to explain to you what's going on. We're not just sitting here, you know, saying, oh, woe is me, you know, eventually we'll be right. No, there's games being played. We know what the games are. We're trying to play them as best we can and protect the downside.
And
maybe,
it's
Jason,
a great.
You may want to talk about the other shenanigans going on with the Treasury and Yellen and Japan and China, frankly, printing trillions or close to a trillion.
Yeah, and I think that I'm gonna talk pretty in depth about that. But one thing is, you know, there's a lot of confusion. I mean, there's confusion on the hedge fund side, like you said, where they covered the majority of their shorts. I mean, it was it's like a 6 standard deviation move on the amount of shorts that were covered in one day. So you have confusion on the hedge fund side, you have confusion on the institutional side, you have confusion on the retail side. I mean, not everybody's making money in this. They're seeing the data go negative or more negative on a year-over-year basis, but then you have people pushing the market in the exact opposite direction that the data is telling you it's supposed to go. And this is, you know, these counter trend rallies happen with, you know, individuals covering shorts, and then you have these guys playing the options market. So you have these huge volume flows that we got to take into consideration now. So, but another,
I texted Sorry. I texted Jason something, Michael last night, something with a chart of Best Buy. So Best Buy is bankrupt. Bed Bath Beyond. Sorry, Bed Bath Beyond is bankrupt, right? There's no question. And they've already, if they haven't filed, they're in the process of filing. That stock was up 100% yesterday, 96% to be exact, right? So I went from 2 something to 5 something for no reason. And then after hours, it dropped close to 60% or 50%. That's the kind of craziness going on in this market. So anyway, I just want to give you, I mean, that is so unusual to see a stock up 100% that's going bankrupt, and told you they are last week, and then drop 60% overnight. You know, I mean, Bitcoin's doing the same thing, right? A lot of those crypto things are doing the same thing. So anyway, sorry about that, Jason.
No worries. So I wanted to discuss a few things, which is in addition to why January was so bullish or positive, and the positive returns in January didn't only come from people pushing around the option market, but also came from the Treasury. And before I go into that, John, what was it? $400 billion that Japan printed to hold rates steady, and 600 billion of stimulus in China. So you got $1 trillion right there. Okay. And that was in January.
Japan started losing control of their bond market, so they had to print literally 400 billion out of thin air, and effectively that's massive stimulus.
Yep. So let me explain what's going on with the beautiful. Yeah, exactly. So about 7-8 weeks ago, Janet Yellen decided to raid the federal pension funds and basically use that money to pay for the federal government's activity. Now, we didn't understand what was going on, but we knew that there was an incremental buyer in the market, and we didn't know where it was coming from. It almost seemed like, you know, you had the volume in the options market, but you also had a lot of money going into a number of different indices and stocks, and it was massive flows. We didn't know where they were coming from. So we did a little digging, and I won't take complete credit for this. I'm kind of regurgitating what a guy named Mike Taylor said, but he came up with a very, very good understanding of what kind of is underneath the covers that John and I did a little digging, and we confirmed that that was probably the case. So going back to it, Janet Yellen decided to raid the federal pension funds and use that money to pay off the federal government activities. They basically provided an IOU to the federal pension funds saying that they were going to pay them back. But the federal government will basically run a $1.3 trillion deficit in excess of what they're actually taking in. So basically, Janet Yellen decided to stop issuing treasuries. And treasuries comprise about 110 to 120 billion of newly issued treasuries per month. She stopped, okay? The way she was able to fund the federal government is through taking money from the federal fund pension system, okay? So what she did in funding the government activities is she's basically eradicating the QT that the Federal Reserve has put into the system. They become more tight, right? So Janet Yellen decided, I'm going to combat that. I'm going to decide to do QE, but I'm going to backdoor it. So basically, dollar for dollar, she's backdooring it in fiscal stimulus. So basically, what she's doing is 110 to 120 billion dollars in fiscal stimulus or quantitative easing. Now, there's the issue of pensions still having money coming in. And the majority, the largest buyer of US Treasuries are the federal pension system. Now, if the federal pension system is bringing money in, but they're not selling any newly issued treasuries, who do you think that incremental buyer is? It's the federal pension system. They got to buy something. And if the federal government or the Treasury isn't bringing it or isn't selling any treasuries, then the federal pensions have to go out and buy other stuff. So if they're buying billions of other stuff, it will smother volatility. And until the debt ceiling raises, we will have fiscal stimulus or quantitative easing by Janet Yellen backdooring what would otherwise, fund the federal government. So you have 110 to 120 billion of treasuries that aren't issued every month. This deal is basically the equivalent of the Biden administration issuing a $1.3 trillion stimulus and the Federal Reserve went to QE instead of QT. So you have a $120 billion incremental buyer. Now, what does this look like at the end of the rainbow? Can Janet Yellen keep doing this? When does it stop? It stops when they fund or they agree upon a debt ceiling. And so at the end of this ordeal, you have the federal government that needs to be funded to the tune, of the newly issued securities anywhere from 110 to 120 billion. But then you got to pay back the federal pension system. So the treasuries go out and they're going to start issuing $240 billion worth of US Treasuries instead of 120 billion when the debt ceiling is raised. So she's putting us into a situation where this is it's going to get worse. And we already have, like John said, this negative data rolling through these next few months. So you have a triple hangover, which I would guess is going to occur sometime early summer. And what I'm guessing is, so you have $240 billion of treasuries that you're going to issue, or you're going to have to sell. The federal government's, or the treasury is going to have to sell, excuse me. In April, the student loan deferral program is extinct. It goes extinct. So you have $1.7 trillion or 40 million Americans that have to start paying back their student loans, which we know a lot of those are going to be in default. And then you have the debt ceiling that's going to be raised. And typically the debt ceiling is a short-term objective or a short-term back and forth argument in Congress. It's not. This is becoming a 6 to 8 month ordeal. Eventually, yes, the debt ceiling will be taken care of. But in the interim, you have some weird stuff going on, not the least of which is the options market that John and I have to make sure that we go in and understand going into the day. But then you have this weird dynamic where Janet Yellen in all her glory is going in there and backdooring and putting quantitative easing. And this is why the Federal Reserve Powell is having issues getting the numbers that he wants. He's combating this and he's combating inflation. So you're getting deceleration in inflation, but not at the extent that he would typically like to see. So she's kind of screwing the general investors and the general public, because the Federal Reserve is not going to stop raising rates if they don't see numbers coming down in a significant manner. So everybody thinks this is going to pivot. It's going to get a whole lot worse. So, but even having said that, like, I'm going to leave it to John, but we have to make sure that we have positions that offset these, I'm not even going to say bullish, but these fake, or counter trends upwards. We have to make sure we take advantage of it, or at least alleviate the pressure. So that's kind of what's going on my side.
Yeah, those are all incredibly good points, Jason. So in recap, right, we've got this 0 days to expiration option. This won't last forever. I mean, this kind of manipulation, once everybody starts figuring out, it kind of gets taken out. But it's going to go both ways, and it's going to create a lot of instability, a lot of volatility. Then you had the Japanese pump 400 billion in, the Chinese 600 billion, and Janet Yellen 600 billion, all in an incredibly short period of time. And that, to some degree, created this liftoff, right? Well, that's already starting to kind of go over the other side. I mean, even the 600 billion that Janet Yellen printed, it's already starting to lose its impact on markets. This stuff is all short term. It's like a quick fix, right? You take a shot of coffee, you get your high, and then you get you want to go to sleep. Well, we've gotten the sugar high. It's occurred. It's in the process of slowing down as we speak. I mean, so we're really setting up, as Jason was saying, for a mess come early summer, because you got poor students that are going to have to start making $300 a month payments on their mortgages, which they haven't had to do for 3 years, right? You got Janet Yellen that now has to reverse her $600 billion money print fest and take that out of the market, plus what they need to run the Treasury, right? You've got the Federal Reserve that's looking at the data saying inflation's not coming down fast enough. So what are they doing? They're raising rates into a freaking recession, massive recession. And they're going to continue to do so because their signals are all messed up by these actions, right? Powell's looking and saying, well, the market's buoyant, right? Unemployment's buoyant. Hell, I got to keep raising rates, and I got to keep taking money out of the system because inflation's really isn't going away anytime soon or quickly enough for me, right? And then the real gorilla in the room, ladies and gentlemen, is M2. The money supply is contracting. We haven't seen that. So when you're shrinking the money pool, in spite of what Yellen's doing, in spite of what the Japanese are doing, the Chinese, the money pool is shrinking. As the Fed's raising rates, as the Fed is doing quantitative tightening by removing more capital out of the markets. I mean, when is this thing going to go poof? I mean, last year was horrific. But I'm starting to wonder if this year's the year that it really gets real nasty. So the only reason we did this call today is to show you, yes, we know what's going on. Yeah, we're not happy, right? Market's up a lot. We're down year to date. We had a great December, but who cares, right? That was a month ago. So the point is, hold the fort. I mean, chill out. But we invest for the cycle, not for these 3, 4, 5, 6 week bounces that are very, 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 very common in bear market. This is the biggest bounce in this market since January last year. It's the biggest bear market bounce we've seen. So hence the angst and the calls and the texts we're getting. But this two-shot pass, I mean, frankly, nothing's changed. It's just getting worse. The behavior has gone weirder. The speculation has gone, the manipulation's gone crazier. But fundamentals are still well in line with what we've been preaching now for for 14 months.
What a time to be an investor. It's crazy. But
I'm still shocked I got black hair.
Well, mine's turning gray, so I think by the end of this year I should be completely salt and pepper. But John and I want to do more of these. We want to make sure everybody understands where we're coming from. We don't want people to guess. We don't want them to, think we're not following the full cycle or the data. But it's important for us to be transparent and for everyone to understand what we're seeing in the market and explain it the best we can so you understand the types of moves we're making. So if anybody has any questions, if anybody, about what was said, if anybody has questions about our firm, if anybody has questions about anything that was stated in here, please let us know. You can always email John or I. Clients of ours already have our emails and our numbers. If anybody outside of the clients want to contact us, just go to our website or email info@forecastcapitalmanagement.com. Also, we've been a little more active on Twitter. So if you want to really see in real time what we're seeing, a lot of times we tweet out what we're seeing in the options market, along with some other weird dynamics that we see coming up. Follow us. I think our Twitter handle is @forecast CAPMGMT. So forecast CAPMGMT. Otherwise, I hope everybody has a great rest of their week, and we will see you back here sometime soon. Take care.
Yep. Take care, guys.